Hey, welcome everybody to an options video. So it is Saturday, so I don't really want to talk about an individual SPAC stock or penny stock or any of those stocks that we've been talking about a lot over the past few weeks. However, I want to talk about option strategy because I think there's a lot more than just playing one strategy. I know you like penny stocks, I know you like SPACs if you're on this channel, but options is another great way to make money. So this is my Robinhood account. I don't have much money in here because this is risky money. You know, options are pretty risky, but this is a Robinhood account that I use one strategy and one trade, and it netted me almost $1,300 in this past week. So this account, you know, it started at 4,500 here and it's shot up to 5,800 in the past week. And most of these gains were from one trade with Amazon using a strategy credit spreads, and it was using one stock, which was Amazon, which was near earnings. So the implied volatility was super duper high, meaning options were a little bit more expensive, and we had a perfect setup. Now I'm going to show you guys how to get the setup. I'm going to give a little cliff notes of what the credit spreads are, because I'm assuming some of you all don't know what credit spreads are. And third, I'm going to teach you all how to find setups like this because they're there every single week. You can find them. It just matters on how much time you put into it. If you put more time into searching for stocks, and I'm going to say you're going to want to be doing big blue chip stocks, it's better with the higher valued ones. And just a reminder, there's a lot of risk with options. However, you could trade with way less money than I was. Like I was using $2,000 or $3,000 for this trade, which is not that much, but I mean, you could use half that or a quarter of that and make a quarter of the amount of money I made. But for this example, we used, I think, $2,000. I'll show you guys the trades in a minute. So I'm going to explain this through Robinhood, give you guys some diagrams, just something to digest, just the Cliff Notes version. If you already know this, you can skip over this and I'll show you, setups, how this all works. Real life examples that I've used, not just me talking about it. For demonstrative purposes, I'm going to show this through Amazon because that is what this whole video topic is about. I mean, I think it's really easy to understand whenever I show you real life examples. So we're going to get into that after, but you got to understand what a credit spread is. So a credit spread essentially is you selling a call or put. Either way works with this. It just depends on which way you want it to go. So for example, you sell a call here. The current share price is 3347, as this says right here, and it is sitting at 3380. This is the strike that you do not want it to hit. If it did hit your strike and this was completely naked, you would actually lose a lot of money, basically an infinite amount of money. So to risk manage somewhat, we add another leg to this, and this will be the other leg of the trade. Realistically, you could bring this all the way up here, right? But your risk becomes whatever's in between. So we don't like that. We instead want to take tighter spreads. The most I'll ever do is just a few thousand. But in this case, we have a 3,080 strike and a 3,385 strike. So the difference between that is 3385 to 3380, which would be 5. Options trade in increments of 100, so it would be 5 times 100. So the risk total is 500. If this were to go completely against us for whatever reason, if our analysis was wrong, that's as much as we can lose, assuming we don't cut losses, which in every single situation we have a strategy that we cut losses. I'll tell you guys mine in a minute, but first we just got to get this better grasped. The white one right here is the one that we sold. We received $30.88 times 100, of course, and then 33.85. This is the one that we bought, and we had to pay $29.30. So what we received minus what we got is what we're going to get net, which would be $158 or 1.58, but $158 by February 12th. So all it needs to do for us is not get above 3380. Sounds simple enough, but it's not that simple. Now, as for the put side, it's the same exact thing, but it's just opposite. So we sell the one on the top, we buy the one under. So if we sell the one here for $3,330, we would receive a credit, which means money into our account, of $32.38. And then we would go to the buy side because we aren't doing cash secured puts. We don't have $330,000 laying around right now. If you do, then that's awesome. But we would hit buy down here, and we're just going to go under the same $500 valuation, and we would receive $188 for this spread. Now the goal with this one is for it to not go under, and the goal with a call one is for it to not go over. Okay, so you're usually wanting to play it based on that. If you think it's going to go low, you buy a call spread, you do a call spread. If you think it's going to go high, you do a put spread. And if you think it's not going to move at all and you think it's just going to go in a straight line, you could always set up a condor. So what this means is we have a put side of it and we also have a call side. So in this situation, we still have our 3,330 put. So what we would want it to do is not go below 3,330. We would also not want it to go above 3,375. Now this one has the most risk, but however, it does have a higher reward. I never like setting them both up on the same exact day. One day when the stock is super red, I'll set up the put one because I know it's going to go up. And then the other day when it goes up, 10, 20% or something, I'll set up the call one. It'll end up leveling out in the middle somewhere, and I'll make both sides of the spread and maximize my profits. And that's exactly what I did in this scenario. So hopefully that helped a little bit, but I'm going to show you now the actual trades we took. So here's Webull. This is just a charting system I'm going to show you guys with, but this is the 2 trades that we took. So the first one we took here was on January 28th, and this was a credit spread for a put at 30.60 and 30.90, so it was a 3,000 wide spread. Now this would have been just as efficient with a 500 wide spread. It would have just been less money, obviously. But this was taken on the 28th. So as you guys could see right here, the 28th was right here. Let me get real nice and close. The 28th was after a very red day. As you guys could see, this thing dropped nearly, $100. And I knew that earnings was right around the corner. Implied volatility was insane right here. So the next day I opened up this put credit spread. So for this put credit spread, we received $860 into our account for a risk of 3,000. Now that doesn't sound like the best return ratio. However, if it ever went the wrong way, say this thing the next day went down another $100. However, my line are drawn. My line was right here. If it ever dropped between this line, that's when I would have cut losses. Obviously, it went down the next day, so I could have collected more premium, but I'm not greedy. I'm just trying to make some money, so I don't care. But if I would have panic sold here, I would have lost $400 instead of making $1,300 at the end of the day. So as you can see, big red, buy put, because I want the put side of the credit spread right here, and that was all the way set at 30.90 and 30.60. So it would basically have to plummet well under this for me to lose money on that side. So ultimately, if we just held that side, we would have made $860, because as you can see, we got a green spike up. It ended up at 3,300, and my spread was, if I lost money, it would have to drop under 30.90. So I was $300 above. So I would have made the 860, been happy about it. But yeah, that would have been a nice $860. But instead, I saw a few days later, okay, now we're fast forwarding to the 1st of February. I saw this, okay, this green hike all the way back up to where it was. Now this time I was pretty bullish on the case of Amazon, and I knew that they were going to go up post earnings. It didn't really do as much as I thought I was going to do, but I collected $360 and I played it very safe. I went well above where I thought it was going to end up. Ultimately, I set the low end, the first place where I would lose money, at 3,500. So right here, as you guys could see, I'm going to draw a line at 3,500. So this is where we would have lost money on the high side, and this is about where we would lose money on the low side. So at this point, we set up a condor, and now as long as it stays between 30.90 and 3,500, we're set. We're going to make the 360 plus the 860, which is, over $1,000 in a week, just with this simple strategy. Now, this might sound too good to be true, but it is not. This is something I've been doing well over 2 months now, because I've been able to see this trend. Now, this happens a lot in the market. Whenever markets are really choppy, just up, down, and not a strong bull case or anything like this, this is when these credit spreads really flourish. As you can see, this stock has been trading it mostly in the range here of 3,100 to 3,000, about 400, 500. You can see all these different trend lines here. And it's been doing this since July, really. This is when that range started. We had a very bull market all the way up. This would have not been a great time to have been in spreads, because there's no real directional movement. It's just up. But here, anytime it hits one of these highs that we think is going to be a high, we set a credit spread above, and every time we see it hit a low, we set a put spread below. Now we got to do our own analysis here for every single stock. We can't play earnings every single time. I really wasn't playing earnings that much. I just thought it was going to stay in this range, which it did. This could be a breakout right here, and the next range is going to be between these two, and if that happens, then I'm going to keep playing this strategy with Amazon, because it's free money at this point. Now I'm going to show you a bunch of different examples of stocks that I think trade in a very similar range, or have traded in a similar range in the past. Now this is Googly, okay? So Google, if you guys look in November all the way to around, I guess recently here at the end of January, we could see that it traded in a range of 1,700 to around 1,850-ish. 1,850 is the high there, and then it eventually broke out. This one was in a range. If someone caught this range, they would have been able to play this multiple times throughout this entire range. This is nothing like Amazon's, though, where it was in a range for literal months. This was just in a range for about a month and a half, 2 months, which is plenty enough to make a good buck. Now, when you're around earnings, this is likely to happen, a big hike up whenever you have a stock like this, which is just Google. You know, everyone's very bullish on it. And if you are very bullish on it, you always set the put side. Now, the reason for this is usually this is what happens. Okay, so right here, this would have been a great time to set the put because you've seen that this is the level of resistance or support rather. So we would have gone down here, you know, set your condor anywhere where you can get a decent premium, decent reward risk ratio. So you would have gone, say 1660 and a 1650. That would be $1,000 of risk, and this would be your line of loss. All right, so this is your loss line. This is when you picked it up here, right here. You picked it up in one of these dips. So say this dip. So if we picked it up at this dip, we got a nice premium. It reverses right around. We're already up a good amount of money. We start seeing it pull back. We're getting a little nervous. We create a line here and say, okay, if it drops under this line for a full day, then we should sell out because it's probably going to shift directions down here. However, this is Google. Very bullish cases on it, internet takeover. So we could just stick with our side of the put side. Now, once earnings comes closer, we start seeing this huge hike up. This contract's basically worthless at this point. So we could buy it back for $0, receive our entire money back, which was whatever we got for it. And we're out of this version of the trade. Now we're at a point where it's just choppy. We have no idea where it's going to go. So let's just move on to a different stock. That's the best way to do it. You don't want to stay married to these. We're trading these. We're not owning them for the rest of our lives. You might own them in a Roth IRA, but not in this account. Okay, this is the crazy money account. This is a trading account. So now that we found our darling stock that we have, the final thing we got to worry about is the premium. Now the premium's going to get better as you go further out. For example, I could go all the way out to say March. Okay, so March 19th, about month away, 40 days away. As you could see, these jumped up so high in premium. Okay, so if we go put side, because we think that this is going to go up definitely, and we think it's not, there's no chance it goes under 3,200. Okay, this is all theoretical. This is not actually, I have not done the research on this yet, but 3,200 is our strike. So we would sell the 3,200 one, and then we're going to buy one under. It does not matter how far we go, but if we were to go 500 under, we'd get 155. But even more so, let's do a 3,000 wide spread, because that's something realistically I would do. I would receive $887, and that would slowly decay as long as the stock keeps going up. If it goes down, it's going to get a little more frisky with it, but ultimately at the end of the day, at March 19th, whenever that date comes around, okay, March 19th, once that date comes around and this thing is anything above 3,200, it could be 3,201, I make $887. But while we're going from February to March, it's decaying slowly. So we could take profits at any number. Some people like to take profits at 50%. For long-term spreads, I like 50%. That's a good number. For short-term, I want to get it all, just as I did in Amazon this last week. Another thing to take account of, on really green days, you're going to see that this is, at least on Robinhood, it's going to show these as green and the puts as red. Amazon was up, not very much, but 0.48. So what this means is these premiums went up while the put ones went down. So that's why I say it's best to do the call side on green days, put side on red days, and never feel like you have to do both sides. If you really think it's going to go up, don't put one on the top side because you're going to lose money. So just do the put side. It's that simple. Well, yeah, as you can see, we could just see the premiums. Okay, they're let's look at the 3,400 one. 3,400's at 112.10. Now let's go all the way to February 19th, for example. That same spread is going to be, it was 34 something, right? Okay, just see, look at these. They're at 44.18 now, 30 or 42.58. Very, very like $1,000 cheaper. So keep those two things in account as well. Once it hits one of these ranges, you need to decide, okay, do I want in? Yes. Okay, check, I want in. Second, is it a red day? Most likely it is if it hits the bottom part, or most likely it's a green day if it hits the resistance line up here that you've set. Now you need to decide how far you're going to want to go out with this. If there's earnings coming up, you might feel a little skeptical, so you want to go shorter term, or hey, you might want to go longer term because you're very bullish on this in the long term, so you're going to set up a put spread for the long term. That's something you need to decide within your own strategy. I would start small though. I would start with these 500s, even though it's not that much money. You're only going to make $230 here and there. It's still money. And once you get more comfortable, you can start going in wide. Now, I think the most I would go is probably 5 to 10. Beyond that, it just gets very, very risky. And at some point, just diversify into multiple of these, not just one. But it could be very, very attractive if you went further. You could go all the way down here. This would be a good chunk of change at risk, but you'd receive $4,100. You received $4,178 for 10K risk. That's pretty good, but it's risk. Remember, it is risk. So that hopefully helped you realize how we got these gains in a week. Now I'm continuing to do this. This is just going to keep on exponentially getting better and better and growing bigger and bigger. This account started at, I think, 4 and it's up to 58. I haven't had it for that long, but I'm just going to keep doing this strategy, keep doing other option strategies that I'll share with y'all and teach you about as we move forward. But for this one, that's going to do it. I'll see you all in the next one. If you enjoyed this, if you want more of these, like this, subscribe, tell me what you want to see next. And also use the referral links down below if you want to get Webull, the charting system I used today, and M1 Finance. That one's 30 free bucks, and that one's ending soon. So get the $33 with M1 Finance. That's the one I would recommend to do ASAP. Also, Webull's ending soon too. So, just get your free money. You don't have to use the brokerage, but get the free money at least. Hopefully this helped. I'll see you in the next one. Have a great day. Bye-bye.